Good Friday morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. JPMorgan coming out of the gate strong. It boosts full-year guidance as second quarter revenue rises to a record, helped in part by its bargain price acquisition of First Republic. Net income surging 67% on the year to $14.5 billion. Trading and investment banking revenue also comfortably beating expectations. Provisions for credit losses higher than expected at $2.9 billion, also in part because of First Republic. And that is a key number as big banks prepare for the impact of a possible recession. On the state of the consumer, CEO Jamie Dimon says balance sheets are healthy and consumers are spending, if a little more slowly. Higher rates also boosting Wells Fargo. It beats the street on the top and bottom line. Total net income for the second quarter jumping there to $4.9 billion. Net interest income, that is the difference between interest paid out and interest earned, rose 29% year over year to $13.2 billion. And Wells is also boosting its outlook for that number for the full year to 14%, up from the previous projection of 10%. The overall earnings beat even more notable after the bank booked $1.7 billion in a provision for credit losses. And this earnings tailwind joining a CPI boost as stocks look to close out the week on a high. Global equities are on track for their best week since March, and stock inflows continue to gather pace, but beware, says B of A, capitulation risk is in the cards. Fed policy will be pivotal to any extended gains. The San Francisco Fed's Mary Daly says it's too soon to declare victory on inflation. Governor Christopher Waller also adding to the debate. He expects the central bank will need to raise rates twice more this year to bring inflation toward that 2% goal. Investor bet suggests that's certainly not a sure thing.
Well, JPMorgan coming out strong in the second quarter, thanks in part to higher interest rates. Profit at the bank jumping 67%, lifted by the company's acquisition of the failed First Republic Bank in early May. Yahoo Finance's executive editor Brian Sozzi is here in studio with the details and everything that you need to know. Hey, Soz.
Yeah, this quarter certainly, I think, checked a lot of boxes if you are, in fact, a JPMorgan bull, guys. First up, as you've been talking about all morning long, First Republic, if you go down this earnings release, big highlight, they saw $2.4 billion in income from First Republic alone. That probably reflects a lot of the exposure of First Republic to higher earning or higher or wealthier families. That is in large part why JPMorgan came out and bought this asset at distressed levels a couple months ago. On a media call, they shared this interesting stat that I thought was pretty cool. They have seen $6 billion in deposit inflows. That is First Republic since the closure of that transaction. So if one was concerned that more about deposits flying out of that asset post JPMorgan life, they tried to put that to rest. But there's more going on in this quarter for JPMorgan besides this First Republic. You had Jamie Dimon, CEO of JPMorgan, calling out consumer resilience. On that media call, our very own banking reporter David Hollerith got a question to CFO Jeffrey Barnum, and he noted he's not seeing any consumer lending tightening, still expects a robust outlook for loan growth and consumer spending. That was a highlight for me. And then, of course, the outlook. Wow, this was a big outlook. JPMorgan net interest income about $87 billion now for this year. Previously, they were looking for $81 billion. So a lot of boxes checked right here and some of those boxes right there.
You know, what stood out to me, too, is that in the statement, Jamie Dimon called out potential regulatory pressures, right? And this is really was thrown into focus this week by Michael Barr, the vice chair for supervision at the Federal Reserve, making comments earlier in the week talking about the additional capital requirements that are going to be necessary for banks. In the statement, Dimon talks about the potential that this is going to happen. He says, we'll manage through it, whatever it is. But he said, we caution that material regulatory changes would likely have real-world consequences for markets and end users. Now, undoubtedly, he's right. This is something we've been talking a lot about, potential regulation. At the same time, it's a little rich that he's saying this, given the quarter that this bank has just had. Oh, poor us. What are we going to do if regulation comes? I think you're going to be just fine.
Right on, Julie. I mean, that's what I'm talking. Right, and it was interesting. I actually teed this question up to Jamie Dimon was calling into the media call from Europe. He was on there with Jeffrey Barnum, the CFO. I thought he would have answered the question I asked him on these very Basel III, given his comments on the earnings release. Barnum took that question, kind of downplayed, I would say, the potential impact, but again, really drove home the fact that if these requirements go into effect, that would be about a 20% increase among larger banks in the capital they're supposed to hold on their balance sheets. That it might impact the economy, it might impact financial markets. But again, that's a lot of if.
I mean, just one more figure here from this quarter. quarter, the company got a 25% return on tangible common equity. That is huge. And so much bigger than the other banks that reported.
Yeah, I mean, I'm still just kind of latching on to some of the consumer statements that you were making from the bank. And Jamie Dimon basically saying within this that the economy continues to be resilient, consumer balance sheets remaining healthy. Consumers are spending, albeit a little bit more slowly. And it's going to be interesting as we go on throughout earnings season where it shows up that consumers are spending a little bit more slowly. We had JPMorgan's Jordan Jackson on with us earlier this week who said the consumer, and as he was describing them, they are bending, but they're not breaking. But even as you're having some type of decision making be needed to employed by consumers, where does that mean they're trading off or trading down even more?
Very interesting start to earnings season this week. PepsiCo CFO Hugh Johnston came on our network yesterday talking about a lot of consumer resilience, paying more for snacks. You talked to Delta CEO Ed Bastian, striking upbeat tone on demand. And then you have earnings results out of JPMorgan and Wells Fargo, which we'll get to, telling you that the consumer is not completely falling apart. Both companies showed strong volume growth in their credit card businesses. Now, autos wasn't good. Home lending not so good because of higher rates. But again, consumers are at least out there buying stuff, whether it is trips and maybe to a lesser extent clothing.
Yeah, so let's get into Wells Fargo. What stood out to you?
Stood out to me, like I just mentioned, consumer demand holding up pretty well. Home lending down 13%. Maybe that probably is to be expected given rates have come. But by and large, this was a commercial real estate focused earnings release from a Wells Fargo, and they raised their outlook. But again, a lot of focus on commercial real estate, taking a $949 million allowance for credit losses, mostly as it pertains to commercial real estate loans. Now, I asked CFO Mike Santomassimo this morning on the media call, what are you seeing in commercial real estate? Now, he did not say that they're seeing zombie buildings out there or people completely delay payments. This reserve really reflects what could happen in the months and quarters to come, given the elevated levels of interest rates and the impact that has on commercial real estate. But I wouldn't say alarming just yet. Wells Fargo went a long way to say this is not a systemic problem yet, but we'll be saying this in 2024 to be determined.
Yeah, most definitely. So this morning, I just want to round it out and talk about Citigroup myself because I was looking at some of the numbers there. It's interesting this morning because we have the number one credit card issuer in JPMorgan and the number two in Citigroup reporting their numbers. And in the case of Citi, that company doing well as customers are borrowing more. They're putting more on their credit cards. At the same time, there was a 78% surge in write-offs tied to consumer loans. So that is quite interesting here. The people are putting more on the credit cards, but there are also not the same repayment rate that we had been seeing with that. 11% jump in revenue from U.S. personal banking, in particular for Citi in the second quarter. And overall, the company beat estimates by 2 cents a share, even as expenses rose by 9%.
I'm a little sad today, guys. Jamie Dimon only answered one question on the media call. I was looking for something big from him, calling out maybe 7% interest rates or something that could really get me excited for the weekend and everything I do to prepare for the week ahead. And he didn't give it to me. I'm bummed out.
Sorry. And Jane Frazier's not dumping in here.
I needed something, Brad.
It looks like CFO Mark Mason is the one who's answering questions.
Yeah, I needed something
call.
Negative or extremely positive. Jamie Dimon really didn't give me any of that. But I'm going to listen to your analyst call soon.
I mean, the numbers are pretty positive.
Yeah, I don't know. You're always looking for that next big thing in journalism, that next big story. And Jamie didn't give it to me. So
well, you can comb through the balance sheets this weekend. Plenty of time.
All right, fine, fair enough.
Yeah. All right. Saz, thanks so much for joining us this
morning.
morning.
Great to be here.
All right. Well, coming up, and right now, actually, the results from big banks kicking off a closely watched earnings season. The so-called Big Six will demonstrate if they recovered from one of the most challenging periods for the industry since the financial crisis. JPMorgan's results show it's still able to make lots of money from its loans and franchises, but will smaller rivals hold up? And just how healthy is the financial sector? A lot of big questions there. We're going to bring in some big guests. David Ellison, Hennessy Large Cap Financial Fund Portfolio Manager, and Victoria Fernandez, who is the Crossmark Global Investments Chief Market Strategist. Thank you both for taking the time here with us this morning. We've got a lot to dig into, especially on the back of these bank earnings. What does this tee up for the rest of earnings season from your perspective, Victoria?
Well, I think when we're looking at this earnings season, we have expectations that they were going to be down around 7%. That's what analysts were saying. And everyone looks at JPMorgan to say, all right, let's kick it off and get a feel for what we're going to get. And if you look at the numbers we've seen so far, Brian was talking about a minute ago, you have Delta, PepsiCo, JPMorgan, Wells Fargo, they all did really well. Now, we know the bar has been lowered. So the question that a lot of people had is, is just beating the number good enough right now? Well, based on what the stocks are doing, it seems like it is. So does this hold up for the rest of the quarter? We don't know. Margins is something that we want to really pay attention to in regards to the pricing power of companies. When you look at the net interest income that you're seeing on these banks, it's telling you that they're doing well. Loan growth was up, at least in the big banks. We know we're going to see some differences when it comes to the regional banks. It's a very different story. Their balance sheets look very different. But for now, to kick it all off, it seems like we're off to a pretty decent start for this quarter.
Hey, David, let's get into the banks a little bit more. Your area of focus here. JPMorgan, again, just like hitting it out of the park. And it's just sort of fascinating to me. The consistency. Yes, they got a lift from First Republic. What stands out to you from the quarter?
Well, I think investment banking was a lot better than I thought it was going to be. But I think generally they benefited from the fact that they got covered, in a sense by the government during the Silicon Valley problem, where everybody said, well, they're going to be okay. So everybody rushed to the big banks, and they're benefiting from that. And so is Wells Fargo and a little bit of Citigroup as well. So. But I think generally people have been worried about credit since 2008. And Jamie Dimon is my age. I went through 2008 like he did. And I don't think we're going to have a credit problem. We're going to have a normalization of credit. And so the real story in this space is what's happened to the yield curve the last 2-3 years. And we're starting to see the benefits of higher rates for the banks. And I think historically, this is a great range for the banks to operate in. If they can make loans at 6, 7, 8% and raise money at 3, 4, 5, that's great for them. And we haven't had this rate structure in almost 20 years. So we're going to start to see that manifest itself in earnings and higher net interest income over the next, year or so, maybe 2 years.
David, how concerned are you about expenses at the banks? That was a big area of focus going into these earnings reports. I see for JPMorgan, there was an 11% increase in non-interest expenses, in part because of compensation. Wells Fargo, the total there, $13 billion. And we saw an increase in expenses over at Citi of 9% as well. Is that a concerning level at all? Is it something that you think that investors need to pay attention to?
Well, certainly I haven't had the chance to really dig into what's going on there, but I think generally that they're still battling a lot of regulatory stuff. Obviously, the Silicon Valley thing generated a lot of concern about what they were doing. They really haven't benefited from technology like other companies have. They've had a lot of competition, so they've had to, keep expenses up, meaning they're, competition from other non-depository. So I think generally that's not the story. Again, I'm going to come back to the fact that the yield curve has been historically ugly for these guys. That's bad for the banking industry. As that unwinds in the next couple of years, you're going to see big increases in earnings. And these big 5, these big 7 banks, I think they're going to be great places to be. Long term, you throw in a little M&A and you've got a pretty good, view forward, pretty good runway here the next couple of years.
Victoria, it's particularly interesting how the banks talk about the consumer right now and the state of the consumer. You got JPMorgan basically saying that spending, they're still spending, but a little bit more slowly. And then even if you look through some of the card metrics that these banks have put forward, Citi, they saw double-digit cards growth. So I wonder, even if they're saying that the consumer is healthy right now, at what point does the consumer start to show signs of being unhealthy, especially if they're leaning more into some of the credit services or the card services that banks have, and they're changing the way that they spend, even if they're not, spending as much as they were before. They're just changing or tapping different areas of spending as their cash buffers run out.
Right, and we have seen that all through COVID, the shift in the way that consumers are spending. But we look at credit card debt. I mean, Julie was talking a minute ago, you've got JPMorgan, you've got Citi. These are the 2 biggest in credit card issuance. You look at Capital One Financial that does a lot of credit card business. They actually came out this week and said they're seeing delinquencies go up some. So I think you have to start watching what those delinquency rates look like. Right now, I don't think it's something to be concerned with. The consumer continues to be strong. But here's what I think we need to pay attention to. We talk about the consumer slowing down, but if we see inflation continue to go on a downward trajectory and the wages and the labor market stay strong, which is the situation that we're seeing, then real incomes actually are going to go higher. We could actually see more demand come out of consumers. And then where does that spending go? Does it go back to goods? Are we going to see goods inflation start to rise again? It's very much a cycle that we have to work through. And because the labor market is continuing to hold on, you've got a consumer that's continuing to spend. Even though we've seen saving rates come down, right? During COVID, savings rates got up to around 35%. They're down now back to around more historical averages, around 5 or 6%, but still they have the ability to spend. And I think until we see the labor market really have some large cracks in it, until we really see those layoffs come in and people starting to struggle, then you're going to continue to see credit cards do well and the consumers spend.
David, as you look at the banks going into the second half of the year, is there anything that could derail what looks like some good forward momentum here? I mean, we are obviously going to see a fading effect from the First Republic, boon that JPMorgan got, for example. Is there anything else you're watching that is a risk?
Well, I think the risk is that, the yield curve stays very inverted and we get a big rally in the long end, meaning rates fall and the short end doesn't fall because the Fed is not going to let that happen, let's say, for the next 6 or 9 months. And then you're back into a, squeeze on margins. So I think, the credit issue, I obviously think about it, but I'd rather be making loans at 6, 7, 8% and have credit problems than be making loans at 3% and have no credit problems, because it's a much better model for an active portfolio manager like myself, because I can hopefully pick the better managers that are going to make the better loans and be able to take advantage. So I think the risk is still, in my mind, the term structure of interest rates. That's been the problem. That was Silicon Valley. That's why JPMorgan got that great, they made a great purchase, and they're seeing the benefit of that now. That was all the term structure of interest rates. And so if the term structure of interest rates improves, I think the stocks all go up. If it stays where they are and gets worse, the stocks go down.
All right, well, we'll see which thing happens. David Ellison, great to see you. Hennessy Large Cap Financial Fund Manager. And Victoria, you're staying with us. Amid first quarter recession chatter, the S&P companies have given investors a tailwind by surpassing, admittedly modestly, the expectations. This time around, the bar seems to be higher, but as talk of an earnings recession continues, will history repeat itself? And is simply beating the street not enough this time? With more on what to expect, let's bring in back Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Victoria, so we've been having this sort of high bar, low bar conversation going into earnings season here. What do you think here? Are our expectations running too hot or too cool going into the numbers?
Well, look, no one wants to overpromise and underdeliver, right? We always see companies do the opposite. So expectations down around 7% for this quarter. I think companies have set themselves up in a position where they can at least hit expectations, if not beat expectations. You had a lot of concern just 6 weeks ago that the banks were going to have a horrible quarter, and people were very concerned. We saw banks take a big hit after March when all the stuff was going on with the regional banks. We actually at Crossmark stepped in and started buying some of these banks because we knew that their balance sheets were strong, and I think that's the key component. When we look at earnings this quarter, let's look at the quality of earnings. Don't just look and see did they beat expectations, but what is the quality of their earnings? What do their cash ratios look like? What is management doing in this volatile environment? You're going to have to piece through it a little bit, I think, to see which companies can really do well in the second half of the year, as we think there's going to be continued volatility going on. But for right now, beating expectations seems to be okay, as all of these stocks that have reported so far have been up, and the big names today are even bringing up the regional banks with them in the pre-market.
Yeah, Delta CEO Ed Bastian told us that this would be a choppy earnings period, and really laying out some of the bifurcation between some of these services versus goods producing companies that are going to be reporting here. As you think about where that bifurcation may be taking place from your perspective, what most notably would you be watching for?
Yeah, when you look at goods versus services, right, we saw the disinflation come in the goods first, and we expected that as supply chains got better. And we're continuing to see that supply chain improvement, which means we should continue to see disinflation in the goods services. The question I think comes in, and we touched on it just a little bit earlier, is the pricing power of some of these companies. Does that start to erode as we go into this new kind of environment in the second half of this year? And if it does, what does that mean for margins for these companies? I think it's a very key ingredient that could really kind of separate companies from each other, even within the same sector. What do those margins look like? How are they controlling the costs? We talked about cost at banks, but you think of cost across the board and how so many CEOs are focused on really reducing those costs that they have. So margins, I think, is going to be something we really want to watch. Services continue to do well. We saw core service spending or core service inflation continue to go a little bit higher in the CPI report. They say airline prices are down 20% year over year. I haven't seen that, but it must be out there somewhere. But maybe we'll start to see it a little bit more in services. It's just not quite there yet.
So on balance, are you bullish or bearish, Victoria?
Yeah, it's hard to tell sometimes. I even question myself, but we're typically more bearish than I think the average money manager is out there, or the average investor, because there's so many factors out there, Julie, that are saying, wait a minute, we're waving a red flag here. We've talked about the inverted yield curve with the banks. Look at M2 money growth. Leading economic indicators down. I say it all the time. I sound like a broken record. 14 months in a row. We've never had that without going into a recession. So you have to sit back and go, then why aren't we there? Why haven't we gone into a recession? And are we being stubborn in that outlook that we think we will see a large pullback or a mild recession, however you want to categorize it, in the second half of this year or towards the end of this year? And I think it comes back to the consumer is spending more than they ever have. And it also comes back to the fiscal stimulus that we've seen from the government. You've got infrastructure bills coming into play. So we have manufacturing PMIs down. They've been in contraction territory for multiple months, but we have factories being built at the fastest pace we've seen in a few years. So there's these contradictory things going on that tells us it's going to be choppy, but we're still leaning right now towards having, again, however you want to categorize it, a mild recession, larger pullback in the fourth quarter of this year. But we are giving credence to the fact that perhaps we pull it out and get a soft landing.
And so, even within that environment, so many companies have continued to say, all right, macroeconomic backdrop, just so challenging to really give proper guidance or go without perhaps sandbagging the guidance that we are giving. So are we looking at a continued period of time where companies are just going to continue to either kind of lower or level set their earnings and then just continue to beat on lower expectations?
I think that's probably going to be their goal, at least for the next couple quarters. They probably want to get to a situation where the Federal Reserve gives a pretty clear outline of where they're going to stop raising rates when they're done. They want to get a clear picture probably of what other central banks are doing, the ECB and the Bank of England, when they're going to be done. Then at that point, I think companies are more willing to take a little more adamant stance, be a little bit more risk on. But it's tough to do that when you don't know for sure exactly what the central banks are going to do and what that inflation looks like. Yeah, we had a great CPI number, but let's see that trend go a little bit closer down to the target rate of 2%. We still have quite a ways to go before we get there. So I think companies will be cautious. I think investors should be cautious, Brad. I mean, we're a little more bullish than the average person, but yet we still want to be in the market. We're just trying to choose where we're in the market a little bit more carefully based on that outlook. So I think companies can maybe take that same cautious optimism when they're doing their business.
All right, Victoria, stay with us. We've got a little bit more to discuss here because as we were even kind of teeing up this discussion, where is the recession? Leading economic indicators have fallen over each of the last 14 months, signaling with flashing red lights that economic deterioration is on the horizon. Yet inflation has fallen, labor remained resilient, and the market is rallying. So are fears of recession overblown? We're bringing back in Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. So Victoria, when we think about the mentions that we had seen of recession in the prior earnings season, really kicked off by some of the bank executives here. I've been doing a Command F or Control F through some of the releases thus far, and I haven't seen a ton of mentions of recession. Perhaps that'll come forward in some of the call transcripts that are taking place. But it also seems like companies are still investing heavily, and if any area that they are, AI has been one that has continued to be kind of that through line talking point. So what is keeping a recession at bay right now? Is it AI alone, or is it something else out there?
Yeah, I don't think we can say it's AI alone, but I will say that when we look at the breadth of the market and where that was a couple months ago versus where we are now, we've seen some really strong improvement there, even though it's still those same top 7, top 8 names, however you want to categorize them, that are leading the market and that are responsible for the majority of the gains that we've seen. The breadth is starting to do better. And for us, that's a positive sign. Again, we're still bearish on the market because of all of the other red flags that are out there, but things are starting to look a little bit better. You've seen small caps do a little bit better. So there is a sense of optimism there that perhaps things could start to improve a little bit. I think that's a very intermediate term view. If we look longer term, I think there are these elements that are no longer going to be propping up the economy. So much liquidity, Brad, has been put into the economy over the last year that has really propped things up, and I think has masked some of these elements that we typically see, these recession indicators, has masked that and has buffered the effects of that, along with the fact that our economy is different than we were back in 08 and 09. The Fed raising rates does not have the same tightening effect on the consumer and on businesses that it did back then, because so many people have locked in lower rate loans, they're fixed rate loans. We don't have near the exposure to adjustable rates as we had a few years ago or as other countries do. So structurally, things are a little bit different. We've had the Fed step in immediately after the banking crisis. We've had fiscal stimulus that I mentioned a moment ago. We've had stimulus for the consumer. So you've had these buffers that have kept us from going into the recession that I think ordinarily we would. How long do those buffers last? I think that's the key as to when we see a recession come and how strong or how weak that recession will be.
One thing that we haven't talked as much about in this conversation is the AI piece of all of this and how much that's going to contribute to growth or not. Do you think the expectations for that are really high going into this earnings season?
They definitely were last quarter and heading into this season. I mean, you just had to mention AI and it seemed like your stock took a bounce, right, Julie? So are we going to see that again? I think now investors are going to be looking to say, okay, great. I understand that AI can be beneficial to your company. I understand that this can be something that will prove over the longer term to be a boost to revenues and to what you're doing. But what are the costs of this going to be? We haven't heard too much about that. What is going to be the investment cost to get AI to monetize for these companies? I'm hoping we hear more of that this quarter. It may be next quarter that people start to dig into that a little bit more. But I think there's a question that hasn't truly been addressed. And yes, it's great, even though I'm going to admit maybe it kind of tells my age and that I'm old school, but it scares me a little bit what all some of these AI things can do. But what is going to be the cost of this in terms of jobs, in terms of infrastructure build for them? Is that going to benefit certain companies like cloud businesses? Is it going to hurt labor? These are all questions I don't think we've truly worked through, and it's the things we want to hear going forward and kind of get the rest of the story.
Victoria, it's always great to see you. I hope you have a great weekend. Victoria Fernandez, Crossmark Global Investors Chief Market Strategist. Thank you.
My pleasure.
Well, we got the opening bell coming up in just a bit. You're watching Yahoo Finance. What do you predict will be the theme of this earnings season?
Resilience, I think. I think it will be. We have a resilient economy, and I expect to see resilient earnings. So I think that will please the bulls overall.
Well, we just had the opening bell on Wall Street, so let's do a quick check of the market sponsored by Tasty Trade. We are seeing all three major averages in the green, setting up for the best week here since March as we see a climb in stocks that has been fueled by a couple of different factors. Of course, we got the CPI and PPI reports this week showing cooler than estimated inflation. That's good news. And then, by and large, the earnings we've gotten thus far have been pretty darn good. Brad Smith over at the Yahoo Finance Interactive, Delta, we had Pepsi, we have the banks this morning. Yep. I know it's early. It's like super duper extra early.
But we're having fun.
But we're having fun, and apparently so are the bulls.
This is rip your face off earnings season right now, folks. And as you provided that year-to-date context, we're taking a look at the Dow Jones Industrial Average. I figured I'd pull that out to a year-to-date view. As of right now, we're up by about 4.3% over the course of 2023. But for today, only higher by about 0.5%. We'll see what more we can add on as we go on throughout the rest of today's trading session if we hold on to those gains. Nasdaq Composite, that's up right now by a little more than 0.25%. 0.3%. We'll be generous and round that off too. Why not? It's Friday. We're up year to date on the Nasdaq by about 35%, so doing handedly well there. And the S&P 500, you're seeing that up by about 0.25% here this morning on this Friday. Year to date, 18% in gains there. Since we mentioned the S&P 500, you know what time it is. Let's take a look at the 11 S&P 500 sectors. There it is. All right, XLE pulling up the caboose. That's down 1.2%. It's in the red. We're about as split as you can get on an 11 sector basis here as we're taking a look at healthcare leading the pack. That's up by about 1%, but between the leaders and the laggards, as I was mentioning a moment ago, it looks like we've got about 5 leaders out of these sectors right now. So that would, simple math, net you out with 6 laggards. Taking a look at the mega cap tech stocks as of right now. Apple, that's pulling, moving lower as of right now. It's down by about 0.2%. However, you're seeing gains in one of the names that we're going to talk about in a moment. Microsoft, that's up by about 1.5%. Google, Alphabet, Alpha Google, whatever you're calling them on this Friday, call them up by about 1.2%. Amazon, Nvidia, also having a good day. But Tesla, for you car folks and fanatics out there, you're seeing that down by about 0.3%. And then lastly here, since we mentioned some of the EV players here, well, we mentioned Tesla, so we'll mention the rest of the EV players. We're seeing all of them, more weight towards the upside as of right now. Another company we're going to check in on in a moment, Nikola, that's up by about 21%.
Yes, it is. All right, let's talk about some other earnings. BlackRock joining the big banks in releasing its numbers this morning. Shares are down about 1.2%. The world's largest asset manager beat profit expectations. It did take a hit on inflows, but it's all relative when you're talking about BlackRock and inflows, because this is a company that manages $9.4 trillion. $9.4 trillion in assets under management. As you see, the company took in less money than it did at this time a year ago, but it still took in $80 billion. So it's all about expectations. It's all about relativity here, I suppose. Long-term investment products, things like mutual funds and ETFs, took in $57 billion, and that is, again, a little bit below what analysts had been anticipating.
Yeah, saying that they're in some of the early stages of client consolidation for their investment management and technology requirements. They're pivoting this story for BlackRock going forward, too, as a platform as a service technology, which is particularly interesting to me, something I'm going to go back and read in a little bit more on, but they're saying that it's going to allow them to deliver investment and technology outcomes a little bit better, and that's resonating early with clients as of right now. You mentioned some of the overall figures in that $190 billion of total net inflows in the first half of 2023, $80 billion of that in the second quarter. And then just lastly here, saying that they also are having more of their clients look to do more with Aladdin. And it's been interesting to learn a little bit more about this quarter over quarter and what type of context they provide around that business, but seems to be growing out some of their technology offerings here. But that kind of an early read here on BlackRock, even as shares are down by about 1.5%.
Yeah, I think that's the revenue miss, compared with what analysts were anticipating, and seeing a little bit of a decline there of about 1%. So that could be what's going on here. It'll be interesting to listen to this call as well to see if Larry Fink, the CEO, has anything to say about the broader economy, because obviously they have a big reach. UnitedHealth Group also reporting its second quarter earnings before the bell. If we take a look at the stock there, the shares are up 4%. The healthcare giant saw $92.9 billion in revenue in the second quarter. That's a 16% jump. It was driven by growth in its insurance business and its Optum Health services arm. The company also, though, saw an increase in its medical loss ratio, the share of premiums spent on patient care going to 83.2%, that coming primarily from outpatient care activity for seniors. So that not as positive, but overall the number beating estimates here, and the shares benefiting from that. And it looks like the company for the year boosting the lower end of its profit forecast as well.
Yeah, I think for the street and some of the calls that we've seen come through, especially focused on the healthcare insurance or even some of the PBM businesses out there too, there's been more of a tenor to say that people who have been holding off on some of the elective surgeries, some of the spending within that kind of healthcare system, and now are looking to make sure that they could take advantage of those opportunities, that's going to benefit companies like UnitedHealth and some of the other kind of tertiary players out there. And so I looked to this one figure that they actually pointed out within the results. Lost my place here for a hot second, but it was talking just about the number of members that they have also added on. I believe the figure was 1.1 million. There we go. UnitedHealthcare, total people served by UnitedHealthcare with medical benefits, that's increased by over 1.1 million year to date. And so it'll be interesting to see how those people tap into either in insurance plans and where premiums also move from here too.
Yeah, and I should mention that medical loss ratio, even though it was higher, that's something the company had sort of called out, said medical expenses were going up, but it did meet analyst expectations. So that could be why the stock is not getting hit by that.
Certainly. We're going to track UNH as we move on throughout the rest of today's trading session. We're also tracking MSFT. There it is on your screen. It's up by about 1.5%, as well as ATVI. We're tracking them too. After a UBS analyst said that the stock is too attractive to stay neutral, analyst Carl Kierstead upgraded the tech giant to buy from neutral and raised his price target to $400 from $345, citing some near-term AI catalysts and stabilizing in its cloud infrastructure. This comes after a federal judge ruled that Microsoft's acquisition of Activision, that other ticker that I mentioned, would not hurt video game competition. The FTC is, of course, appealing this decision.
Okay, so a couple things to talk about here. Interesting in this UBS call, the UBS had downgraded Microsoft earlier in the year and said that spending trends for Azure were deteriorating. Now they say they're not getting better, but they're not getting worse. So maybe we have seen a trough here in those trends. So that appears to be part of what is behind the upgrade that we're seeing here. They say Azure and AWS cloud infrastructure spend is beginning to stabilize. So that is where the positivity is coming from. So that is the UBS piece. Now, as for the Activision piece, there are a couple different things going on here, of course. The UK regulator, which had rejected Microsoft's acquisition of Activision Blizzard, is now taking another look, basically starting a fresh assessment.
Review.
Thank you.
With the hold up, wait a minute.
Of what's going on. So that's happening. There was some question actually about whether the FTC was going to appeal this process. What they're doing now is asking the appeals court to halt the acquisition while the process is still going on. All of this said, Activision shares are not trading as though the deal is not going through.
Right.
So there's a lot of noise out there from the UK, from still the FTC, but it seems like the market is now done with it and moving on and saying this is a deal that is going to close.
Yeah, and if we were looking at that chart once again, I'd actually pulled back the chart yesterday to the point when this deal was announced early in 2022, and shares are above that level from what I had last checked yesterday. And so all of this, to your point, it signals that the deal is expected to go through, and if it is successfully fully consummated, then you would be looking at a company in Microsoft that really owns every part of that gaming experience, from the console all the way to the creation of content and then to the monetization of that in-game experience as well. At the same time that they're very much invested in different tentacles across their business, as we well know. We didn't even talk about the pending AI catalysts that were called out within this UBS note, saying that there's already a lot of AI enthusiasm within the stock. So all of these things holistically considered, you're looking at a powerhouse in Microsoft that is like a freight train that can't really be stopped at this point.
Yeah, but the court says
hold up.
Well, the court said go ahead. The FTC says hold up.
The FTC, yes.
Yes.
Well, and UK regulators said, well, maybe we'll buy another ticket. We'll see. I don't know. Train analogies. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What extracurricular activity helps you find balance?
Oh, that's a good question. I swim a lot.
Do you?
So, and I find it, at the end of the day, I swim and it lets me switch my mind off. And that, I think, is really important for me.
How many laps do you do? Are you a lap pool guy?
Yeah, probably about 50.
Wow. Impressive. I'm an aspiring swimmer. I'm not quite, I want to do it. I haven't quite pulled the trigger yet.
The market just keeps going. Can't make it stop. How far can the upward momentum, though, take us? Let's go to Jared Blickery at the New York Stock Exchange for more. These markets, man, they just keep going, Jared.
I know. I was just looking at the Wi-Fi Interactive here on our global heat map, and this is another Superman week. If you're taking a look at this chart, it's up, and away from the lower left to the upper right, up almost 4%. That's the Nasdaq Composite. Looks like small caps giving a little bit back today, but the Russell 2000 up even more than the Nasdaq this week, and the laggard is the Dow. That's only up 2.3%, but I just want to show you what's been happening around the world, just to give you the sense of all-around bullishness. Australia, the All Ordinaries, up over 3.5%. You can take a look at what's happening in Hong Kong. That's the China proxy. That's up over 5%. Huge, huge burst there. What about Europe? Is Europe sick? Well, the London FTSE is up 3%. And let's take a look at the DAX over in Germany, just down nominally today, but up 3.5% over the 5 days. Now, let's take a look at what's going on inside the US market. And here's our sector action today. Healthcare in the lead, kind of a balanced, some winners and some losers here. Let's take a look at the 5-day price action. Communication services in the upper left, that is the #1 sector, followed by tech, followed by consumer discretionary. Guess what? those are the mega cap sectors, once again attracting a lot of cash. Here's a Nasdaq 100, Nvidia up 11%, right there in the middle of your page. Amazon up almost 4%, Google more than 5%, Meta more than 7%. So what's going on here? Well, with the tame inflation report, we have seen the 10-year T-note yield really crash back to, after punching above the 4.0 level, crash back to substantially below that. I just want to show you a longer term chart. Here's a 2-year. We are in a sustained uptrend, so one might expect higher prices until otherwise proven, but this is just a big consolidation between what I'm going to call 3.5% and just above 4%. So that is still in flux with the big decision of where are we going to go long term. But the dollar has been cooperating in terms of the risk on movements. Let me dial this down to a three-month chart, and you can see really just crashing below the 102 level and gaining momentum to the downside there. So that's pretty impressive. You take a look at a 5-year chart, it's right there in the middle of the range. This is the COVID range right here. Early COVID, late COVID, right smack dab in the middle. In the meantime, stocks like the weaker dollar. So I'm going to go back to our heat map. Just want to check up on what's happening with the banks, and I'm going to put this back on an intraday. JPMorgan, what can I say about Jamie Dimon's comments? Pretty surprising to me. He almost seems surprised that we are not in a recession or that things aren't worse than they are, but he mentions the consumer strong, economic data still rolling in, things are weakening on several fronts, but JPMorgan, as always, the fortress balance sheet able to protect and hedge against that, I guess. But I think his candid admissions is that we don't really know what's going to happen next. I would be more concerned about a Wells Fargo, which is up 3% today. Their earnings were good as well, but we head into a recession. That commercial real estate portfolio probably not going to be looking so good. But in the meantime, until we have another catalyst in the market here, I've been saying the market's on autopilot. We don't have a reason to add to positions or to remove them right now because most of the big players already put their trades in motion at the beginning of the summer and they're just riding it out. So to them, give them a tip of the hat.
Okay, thanks.
Seems easier than what we're doing.
Yeah, appreciate it, Jared. Well, the Federal Trade Commission is investigating OpenAI over accusations that its AI chatbot, ChatGPT, puts personal reputations and data at risk. This investigation is the most concrete step to date made by the regulator to crack down on the ever-amorphous AI landscape. FTC Chair Lina Khan has long pushed for AI regulation by way of consumer protection regulations. Khan's strategy toward tech regulation is aggressive, and her antitrust efforts to break up acquisitions by tech giants like Meta and Microsoft as of late have ruffled Republican lawmakers' feathers. Yesterday, a House committee accused Khan of bullying and politicizing legal action against big firms. Khan argued that more regulation was necessary to combat the growing concentration of power in big tech. We're joined now by former FTC Commissioner Noah Joshua Phillips to talk more about this. So, Noah, as we look at the current tech landscape, let's zero in on AI in particular here. What do you think the FTC's role should be in looking at AI as it develops?
So, Julie, let me just start by thanking you for having me. It's great to be here with you. The FTC has pretty broad authority. They have authority to look at competition issues, antitrust questions, and also consumer protection. And under the consumer protection rubric, they look at a variety of different kinds of things. We talk about deception, we talk about unfairness, but specifically, they also look at things like privacy and data security and how companies are making claims about what they do and whether those claims are substantiated. And what we're seeing here today is the agency leveraging those tools to look into an area of the economy, AI, where they've been very clear that they're interested in looking. We've seen a lot of statements from last year's report to Congress on AI to a recent statement jointly with the DOJ and the EEOC and the CFPB from the FTC about its interest in looking carefully at AI.
So what are they looking for?
Well, this investigation is looking specifically at a number of different things, but critically, they're interested in how the company is using its models, how it's training those models, how it's assessing risks that are associated with those models, and they're also looking at privacy and data security.
And what do you think, as you watch this all lay out, What do you think is the big, I mean, not as somebody who's in there, investigating it in detail, but what do you think is the biggest risk going forward that the FTC should be addressing?
Well, look, what we have in front of us because of that leaked report yesterday is what's called a civil investigative demand. This is the beginning of a process, and it tells us a little bit about what they're interested in. And they, again, seem quite interested in how the company is thinking about the risks associated with the models that it uses, the claims it's making, and privacy and data security. AI is a kind of software that is now ubiquitous in the economy, and people are using it in a variety of different ways. And that creates a lot of potential. It has the ability to really supercharge a lot of processes that businesses use and allow us all to learn, but it also does present some risks. And I think the agency has been very vocal that that's what it's interested in policing.
How have some of the AI deals that have come about, especially in kind of the M&A or even loose acquisition via stake in companies, how has that differed now versus when you were the FTC commissioner, and how even in the discussions that continue to move forward right now, do you imagine they evaluate each of these different plays that large mega cap tech companies are making?
Sure. So we actually haven't seen a lot of activity in the last few months on AI-related M&A. The biggest AI-related enforcement on some level, which was when I was on the commission, was the NVIDIA ARM transaction. And NVIDIA's chips, of course, power a lot of the really powerful processes for processing data applied to games, but also critically to AI. And there was concern that the agency expressed in that transaction that marrying NVIDIA with ARM in terms of chip design would be a problem for competition in the market. But we haven't seen a lot of this play out in the context of competition. The agency has said that it is concerned about some of the potential risks that AI might present on the competition side. Could you allow algorithms to help fix prices, this sort of thing. But what we saw yesterday, and what the agency has been discussing a lot, is actually the consumer protection side of the ledger. And that's less related to M&A than the competition issues.
That is what they discussed yesterday. But of course, this FTC, I think we can safely say, is sort of popularly perceived as being maybe anti-big tech is too strong a word, but certainly wary of big tech and willing to be quite active on big tech. You're on the other side of things now, if I'm not mistaken. You're working with clients who are trying to get mergers through. From their perspective and your perspective, is that an accurate portrayal of the FTC? And do you think it is appropriate for the FTC to be taking such a tack?
Well, I think what we're seeing is a lot more activity, or at least a lot more talk about activity from the agency. That's reflected in regulations. It's reflected in a recent proposal to allow to ask for a lot more information in the M&A process. It's not really limited to big tech, though. There's a lot of activity going on from the agency, really across the economy.
Okay, and so where does, in the instance that a deal comes across the table and doesn't go through in fear that it's going to give one company too much power in the future, how does that show up as perhaps an economic, consideration in the future?
For the government? Look, I think the view that the agency is expressing is that antitrust laws have been under-enforced. I have my own questions whether that's accurate, but that's the view they're taking. And so their view is that doing a lot of this enforcement supports economic growth. I think as a historical matter, that's not necessarily borne out.
Noah, thank you so much for your time this morning. Helpful to have your perspective here as a former FTC commissioner. Noah Joseph Phillips, who was with the FTC and now is an attorney at Cravath, Swaine and Moore. Thank you so much.
Thanks for having me.
All your markets action straight ahead. You're watching Yahoo Finance. Is the recession still coming this year?
Not this year, no. Next year, yes. This year, no.
And how bad will it be?
Still very difficult to say. I mean, I think the CPI numbers were encouraging, that the Fed won't have to do too much more. So I think when it comes, it will be relatively mild, but it could be quite prolonged.
Coming up, the fight is heating up in Hollywood. Members of the Actors Union are now joining writers on the picket line today. Our Allie Canal breaks down the latest and what the biggest walkout in 4 decades means for the future of streaming.
All your markets actions straight ahead. Stay tuned. You're watching Yahoo Finance.
We just had CPI numbers out. Thankfully, started to come down. I'm curious, though, during this time of prolonged inflation and increase in inflation, what thing has given you the most sticker shock?
Overall, it's the labor market, the continued strength of the labor market, continued high wage growth, and this is what makes me concerned that let's not overreact to one CPI number. We need to see weakness in the labor market coming through as well. We need wage growth to come down. That's still the most important thing for me.
Welcome back. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We are about 30 minutes into, bless you, the start of trade this morning, 34 minutes to be exact here, Shack number. Let's take a look at how stocks are faring right now. The S&P 500 pushing higher today after positive results from 3 of the so-called big 6 banks. Wall Street is coming off of its 4th consecutive day of gains, with the Nasdaq and the S&P 500 reaching their highest levels since April of 2022.
JPMorgan coming out the gate strong, boosting full-year guidance as second quarter revenue rose to a record, helped in part by its bargain price acquisition of First Republic. Net income there surging 67% on the year to $14.5 billion. On the consumer, CEO Jamie Dimon says balance sheets are healthy and consumers are spending, if a little more slowly.
And Microsoft shares are on the up as UBS raises the tech giant stock to buy from neutral. Analyst Carl Kerstead citing some stabilizing cloud infrastructure spend as a key factor, but also near-term AI catalysts that make the stock a more attractive proposition.
And JPMorgan downgrading its trading and price target on telecom giant AT&T. Analyst Philip Cusick dropping that price target by $5 to $17 a share. He also cut the weighting on the stock to neutral from overweight. He cited the prospect of weaker profit estimates from its wireless and broadband divisions as a key catalyst. Well, the results from the big banks kicked off a closely watched earnings season. JPMorgan coming out strong in the second quarter, thanks in part to higher interest rates. Profit of the bank jumping 67%, lifted by, as well, the company's acquisition of the failed First Republic Bank in early May. CEO Jamie Dimon touted the strength of the consumer on the earnings call this morning, but warning there are still substantial headwinds.
The consumer's in good shape. They're spending down their excess cash. That's all tailwinds. Even if we go into recession, they're going in with rather good condition, with low borrowings and good house price value still. But the headwinds are substantial and somewhat unprecedented. This war in Ukraine, oil, gas, quantitative tightening, unprecedented fiscal needs of governments, QT, which we've never experienced before. And I just think people should take a deep breath in that. And we don't know what those things are going to put us in a soft landing, a mild recession, or a hard recession.
For more on this, let's bring in Nathan Stovall, S&P Global Market Director and Director of Financial Institutions Research, and Ken Leon, CFRA Research Director of Equity Research. Good to see you guys. Thank you both for being here. Nathan, let's start with you here. As we look at the banks here, it feels like they're navigating, it's not like this environment right now is unquestionably good for banks, and yet they seem to be navigating it pretty well here. Is that how you would assess it, and how do you think they're doing so?
I think the prints this morning were really strong. I mean, there were two real big issues we were looking at coming into this around liquidity and specifically around the cost of deposits and the stability deposits and then credit. And on both fronts, the big banks look pretty good here. But I don't know if we can provide a clear read-through to the rest of the group. Notwithstanding for the reasons that Jamie mentioned earlier, it's still a little bit early. I agree with a lot of the things that he said. The consumer is strong. We feel like we are headed towards normalization rather than sort of a severe downturn. But the other I would point out is that the big banks seem to have benefited from inflows of deposits from smaller institutions, particularly the regional banks. So while these numbers are good, and they've definitely beat expectations on a lot of those metrics, whether it's credit cost or margins and the cost of deposits, I don't know if we can sort of blow an all clear here and provide a read through to the rest of the group quite yet.
Ken, what do you think? Are we able to call any type of all clear, or is there still more that needs to be uncovered?
Well, it's great to be here, and also with a former colleague, Nathan. So second quarter is an inflection point. We're not firing on all cylinders. The economy is resilient both for consumer and commercial lending. The spreads between deposit costs and the earnings yields they're probably going to narrow, but if the economy remains healthy, we will see loan volume growth. We also are at the inflection point, maybe the trough of the investment banking cycle. So for the big six, which are diversified banks, we're likely to see a pickup in investment banking fees. Trading is what it is. There's volatility that helps. And I think the attention for next year for analysts is going to focus on two things. One would be, is there a decline in net interest incomes, particularly if rates flatten or go down? And second, the big issue is return of capital off of Michael Barr's speech, the vice chair of the Fed, on a holistic capital structure. It means more regulated capital needed. That's the big deal for investors.
It is a big deal for investors, Nathan, but given, again, the sort of resilience of the banks here, how big of a deal? I mean, particularly for JPMorgan, right? If you see these additional capital requirements coming through, how big of a hit is that really going to be for the bottom line and for the stock price?
Well, I think Jamie tried to speak to that earlier and basically say that they'll pivot. They'll find ways to adjust to a higher capital regime. And that's what we've heard from most of the banking industry. And there are some institutions that would come up short, if you look at the group that is above 100 billion in assets in terms of capital levels and where they could go. But I do think it is manageable. And to Ken's point around capital return, that is something that we're waiting for. And I think everybody's kind of in this wait and see mode, both from where the regulatory environment is going to go, as well as where the credit environment is going to go. And it's a little bit early to say, but I think it is something that they absolutely could adjust to. And where these things are being traded right now and priced right now, they're not necessarily being priced off of current earnings. I mean, there's still a lot of doubt priced into these stocks, particularly the regional names. So I think that they can adjust to it. And if the results are better than people expect, then I'm not so sure it's that huge of a story for them.
Nathan, what did you make of the way that some of the CEOs and leadership at the banks right now are talking about the consumer and how they're evaluating where balance sheets for households are, as well as some of their spending patterns?
Well, I mean, if you look at the consumer, remains really strong. Unemployment is still really low. Household debt to income is still near a 40-year low, about 1.5 percentage points below the 40-year average. And while we've seen savings rates come down and we've seen excess savings that were accumulated during the pandemic come down, we're still sitting on some. We've seen card delinquencies come up, but they're still below pre-pandemic levels. So we're still seeing lots of health in the consumer. And I happen to agree with them right now that it doesn't necessarily match some of the fears in the marketplace. Now, it's still early. You know, we're only a year plus into this higher rate regime. You could really even say 6 months into really a land of higher rates. And it takes a while for that to be processed. So I think the jury's a little bit still out, but the consumer does remain strong and it is showing quite a bit of resilience here.
And we're still also really, really early in the earnings season, right? Yes, we've gotten these 3 big banks today, but there are a lot more to come. So Ken, when you look at what we have heard, what can you extrapolate to the rest of the banks, particularly, say, the regionals? And are there any that you're specifically worried about?
Yeah, so as we go downstream in size, there's the super regionals, which were still very positive, like PNC. But then as you get into mid-sized banks, below $100 billion, areas that matter is just the traditional lending and whether they're able to drive still higher net interest income. Commercial real estate picks up as a risk as you go to the smaller banks as well, simply because they're not diversified. They also don't have the ability to generate the excess funds that the largest banks can do, who are gaining market share out there in consumer banking and perhaps middle markets and small business. So it's a tough game for small banks. They need to consolidate.
And then in a different kind of bank, I want to bring up Goldman Sachs with you, Ken, because you just downgraded it from strong buy to neutral, I believe.
Sure.
So what's the deal there? There's been a lot of noise around Goldman lately.
That's right. So we actually, during the bank crisis, if you will, in March, upgraded it from hold to strong buy, a little bit too early on this inflection point of the investment banking cycle. But Goldman has other issues as well. And they're also indicating, that the second quarter might be throw the kitchen sink in with large write-offs of some of these non-core businesses. It's also body language from David Solomon, whether he can show that the strategy they have is going to work. They will gain wallet share in the core business. There's no question about that. But they missed valuable time in the last few years as other competitors have really gained a size and market share in investment and wealth management. So it's going to be a tough issue for David Solomon, and the financial media and investors are all over that next Wednesday.
Yes, we will be. Thanks so much, guys. Good to see you. Nathan Stovall, S&P Global Market Director of Financial Institutions Research, and Ken Leon, CFRA Research Director of Equity Research. Thanks to you both. Thanks. We got all your markets action coming up. You're watching Yahoo Finance. What story do you think we're not paying enough attention to right now?
Demographics. Demographics are behind the problems we have with the labor market in terms of a shortage of workers, not just in the US, but you look around the world as well. Demographics are the problem that people are just not talking about enough, and how that changes the medium and long-term outlook for interest rates and markets.
Let's do a check of the market sponsored by Tasty Trade. As we take a look here, all three major averages remain in the green with the Nasdaq driving it here, up 0.6%. We have continued to see such strength in big cap technology, which is really interesting here. As we talked about, Microsoft was upgraded today. Nvidia, I'm just checking, is up another 4% today. Guess what that means? It's another record for that stock. We'll see if all of these big tech companies can live up to these lofty expectations into earnings, but so far, so good in terms of stock action. Well, there was certainly a turning point in investor sentiment this week, with weaker inflation data boosting bets the Fed could take its foot off the hiking pedal sooner rather than later. But the San Francisco Fed's Mary Daly says it is too soon to declare victory over inflation. Governor Chris Waller says he sees 2 more rate hikes needed to get to where the Fed needs to be. The key question remains, can the U.S. economy achieve meaningful disinflation without pushing us into recession? Joining us for that conversation, Lakshman Achuthan, who is Economic Cycle Research Institute co-founder. Lakshman, good to see you.
You too.
We have been having this conversation with you on an ongoing basis. Sure. So given what we heard this week, what's your current thinking?
Look, it's possible, but that doesn't mean it's probable. So looking at the forward-looking data, just on the prospects of a hard or soft landing, it still looks like a hard landing. Now I'm talking forward-looking data. When you switch to the lead in there, which is can the Fed take the foot off the pedal and maybe give us a soft landing, that would require Fed policy that was kind of preemptive in nature, which we can debate it, but it isn't, right? It's not preemptive, it's more reactive. And so there's a need, it seems, to see inflation in a comfortable area in the rear view mirror for a while. And that's just not there yet. I think we're in an inflation cycle downturn. We called that a while ago. But our forward-looking inflation indicators for the past 6 months or so, while they're down, they've kind of been going sideways. It's forward-looking. And so when you look inside of CPI, which we got earlier, you'll see, yes, year over year, down, headline down. It's the volatile things, right? Food and energy that are really moving it down, maybe even goods to a degree, although that's bouncing along. When you get into the labor market, the core services labor stuff, that's pretty sticky. And the Atlanta Fed has a wage tracker that's sitting at around 5.6% or so growth, and that's just going to be too hot for the Fed.
So that's actually where my next question was going to go, which is how much of an unknown variable is a stronger labor market for the Fed's policy pathway right now?
Well, they're going to want to see that coming down in the rear view mirror. Right. And I think that kind of fits with what some of the Fed governors have been trying to say. All along, right, the market's saying, oh, maybe we dodged a recession, and look, we think inflation's going down, so obviously the Fed's going to cut. And each time we go through a few 6-week cycle or whatever, the Fed says, no, not yet. And they seem to be saying that pretty clearly here, so the expectations are of another hike. And then the question is what happens after that. What's quite interesting, though, is, as you're saying, the investors are pretty optimistic, right? They're saying risk on. No recession, soft landing. I saw a clip of you interviewing someone this morning, I think, and saying just no recession. Not this year anyway, maybe later, I don't know. And as someone who does this my entire professional life, I have to tell you, it's hard to make such a definitive statement like that. There's no real signs in the forward-looking data of a sustained revival in growth.
At the same time, as we know, the recession keeps getting pushed off in time, right? I mean, I don't know if this was the conversation you heard, but one of the conversations we had yesterday with Lee Farage of State Street, he believes that a recession isn't coming till the second half next year, but he doesn't think the Fed is going to be able to cut because inflation is not going to come down enough, certainly not to 2%. So when it comes to timing the recession, kind of where are you on that question?
Well, so my teacher was this man named Jeffrey Moore, Dr. Jeffrey Moore, who created leading indicators and helped define recessions. And he counseled me, taught me when I was younger, you're doing very well as a recession forecaster if you can realize one's happening under your feet. So this idea of forecasting them, hey, that's not the normal thing to be able to do. And so there is a good prospect, I think, that the recession may have begun already. When you look at the various indicators, many of them are sitting in recessionary kind of configurations. And what is very strange here, Brad, to your point, is that employment is still holding up.
Yeah.
And how does that happen? How do you square that circle? And what it really is, and we've talked about this before, is this post-COVID kind of backwash. We have a lot of weird things happening post-COVID. A bunch of people left the workforce, so the labor supply is really tight. You have a huge, sharp recovery, and everybody is scrambling to get workers back in, so they're very reticent to let them go. So look at the classic leading indicators of the employment market, or look at just the employment market itself. Year-over-year jobs growth has been going down for 2 years. If you look at the last report and you look at discretionary hiring, away from healthcare, away from education, but just business activity, that discretionary hiring, it's under 100,000. It's 74,000 new jobs in discretionary jobs. And you look at the forward edge, which is the temp job area, and those are negative, and those have been negative. I think they're off 5% from their highs, which you typically don't see until a recession is beginning. So investors are always trying to look over the valley. I think in your interview, I watched this, where you're saying, I'm not sure, maybe it's longer. I don't know. There's this longer, or maybe it's more severe or soft. And even Jamie Dimon was saying, hey, look, I don't know. There may be something sitting there, but I think the consumers aren't that bad, so they can kind of hold in there. What's going to get really interesting, I think we're in probably a pretty good earnings season because it's all nominal numbers, and inflation makes the numbers look good. But as inflation's coming down, that's going to be a headwind on your earnings growth.
Yeah, maybe we should do inflation-adjusted earnings.
We do. So to your point, just lastly here on consumers, does what we've heard from the banks and their consumers and what they're seeing in the health of their balance sheets, the rate of spending, or even what we're hearing from a company like Delta and where they're seeing services spending continue to be strong, does anything about that signal Q3 2023 recession?
Sure. It does. I think YOLO's going on, right? You only live once. This is the summer. Everybody still has access to credit and things like that, and so they're going for it. And you see that. I think even the banks, or the big banks, right? They're sitting there. They've been able to take out some of the smaller banks, and they have probably some pretty good customers, so they're comfortable for the time being extending them more credit. But credit contraction is a feature of a recession, and it kind of rolls through different areas. And it's been through a few spots in the economy, and it's going to continue rolling through. And therefore, it looks like there's going to be job losses ahead. That would be consistent with a recession. It would look something like an echo of what we saw in the 70s, where recessions began and job losses didn't happen until well inside the recession. And the consumers, there's this stuff, one of the really interesting wrinkles, there's a lot of fiscal pushback on post-COVID, right? So all that fiscal spending, and that's kind of normalizing slowly. There's supply chain things that are kind of normalizing slowly, and that's making it more confusing here.
Yeah.
But when you have, it'll be interesting, I know there was some news this morning on the student loan, forgiveness and all of this stuff. What happens there, because people have taken that payment money, which is around on the order of $400 a month,
right,
and used it for other credit spending. And so if that does come home to roost, that'll put some strain on your quality of loans.
That is a question that we put to some of the execs, at least early on in this earnings season.
Good.
Lakshman, always a pleasure to get some of your time
much.
and insights. Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder, joining us this morning. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What's the first thing you read in the morning?
Oh, it varies.
Yeah.
Generally, I will look through the Financial Times first thing, and then I will look at overnight reports from my office in London, and then try and work out what's going on with the day.
That's what I do too.
Cryptocurrencies have been in the spotlight of the SEC and Congress for a lack of regulation and for how to best protect investors. Judge Annalisa Torres of the U.S. District Court of the Southern District of New York has been presiding over one such case, whether Ripple's XRP token can be classified as a security. On Thursday, Judge Torres provided her nuanced view, saying that the XRP token can be regarded as a security for institutional sales after it passed the Howey test several times. However, the court ruled that XRP cannot be a security when it's being sold to the broad public. So what could this mean for the future of crypto regulation? We're joined now by Berenberg Capital Markets Senior Equity Research Analyst Mark Palmer and Delta Blockchain Fund General Partner Kavita Gupta to discuss more. Great to have you both here with us today. Mark, you're here in studio with us. You know, just your initial reaction, even as you heard this particular case ruling, or at least the opinion of the court come down from the judge.
Well, I view it as a split decision. There definitely were some aspects of this that were favorable for Ripple, but at the same time, there were certain aspects that were not favorable for Ripple, including the fact that it was found to be guilty of engaging in illegal securities transactions with institutional investors to the tune of several $100 million. But the main takeaway as it pertains to the broader crypto space and to Coinbase and the like, in our view, is that number one, the judge did rule that the Howey test is applicable and should be used to determine whether cryptocurrencies are securities, and then things got a bit more nuanced in terms of the application of that, which we think her interpretation may be a little bit outside of the judicial mainstream. And at the same time, she stated that XRP could be viewed as being part of a securities transaction once it's actually used. The fact that XRP itself is not a crypto token, is a security, that doesn't really mean much if at the same time the trading of that crypto token is interpreted to be a securities transaction. So if you're running a secondary market or a crypto exchange that facilitates transactions that are in the secondary market, it appears that she's not addressing that. And there's specifically a footnote in which she says that she does not address secondary market transactions.
Yeah, I mean, Kavita, there was a lot of sort of celebration on crypto Twitter yesterday. It felt like that, this is a blow to the SEC. This is a victory for crypto. And as Mark explains, it definitely feels more nuanced than that. So what do you think is the sort of reading in the community that should be as a result of this ruling?
So I was truly the way we look at it from the crypto community, right? So far, for the longest time, there has not been any rules. There has not been any direction. So the positive side of yesterday's hearing is that if it is getting pragmatic sales, which is through exchanges, which is through centralized or decentralized exchanges, is not a security violation of the same token. But at the same time, as Mark mentioned, doing it for institutional sales, mostly for speculative value, is the way the crypto industry has been thinking is, so the token itself cannot be a security and a not security at the same time. That means there is definitely a step ahead about how do you really place it in the market and how does the sales around it happen. So if it is really decentralized, then the same token is not security. And I think that's a big win, at least to have a clarity or towards the direction of a clarity that the same token cannot be a security or have to go through a Howey test. And I think that's a very, very positive side.
Even after having so many conversations and covering this space for a while, for a lot of end consumers, it can get a little bit muddled or confusing over time too. So how, even in these processes of trying to ensure that there's a safe way forward regulatory-wise and framework-wise for crypto and for blockchain more broadly, that there's still transparency that's at the core of this for the safety around how people can transact with or trade crypto at the end of the day, Kavita?
I completely agree with you, Brad. And honestly speaking, that has been one of the biggest frustration for the crypto community too. What deemed decentralized or centralized from the perspective of SEC. And I want to underline again, like we are talking about SEC, who did, in a way, sign off to the IPO of the Coinbase, came back, listed some random companies or random tokens without giving explanation that these 12 and these 13 tokens are security. And now we are going back to the direction, what really makes them security and not the rest? And is the security is actually not even a token, it's the security is the way or the means the retail customer gets to be part of it, or as a user, or a speculative value. And I think maybe one of the biggest thing for the crypto community, including myself as an investor in the space since 2013, one of the biggest eye-opening for me is the direction not going to be about how we test, or is it about going to be the tokens created or centralized, decentralized, but the way it is placed outside for retail customers for their security. If that is the case, then it may not be even, then the regulations has to be expanded, and the standard digital asset regulations may not be applicable to it. So maybe everything what crypto industry has been saying that we need extended or a new format regulations around it is a very legible way and an ask.
Let's bring it back to specific reaction that we saw in the market. And I want to bring it to Coinbase in particular, which rose yesterday and it's rising again today, Mark. Should it be? Is the feed through positive?
I would question the extent to which Coinbase has rallied in the period after this ruling was issued, simply because I don't see this as being a clear win for Coinbase. One of the things that the SEC alleges in its lawsuit against Coinbase is that it has been operating illegally a securities exchange in which there are significant conflicts because the company is simultaneously running an exchange, a broker-dealer, and a clearinghouse, which in the eyes of the SEC is rife with conflict and ultimately may only be remedied through a breakup of those functions. But I think that beyond that, the fact that the judge ruled on primary transactions involving Ripple, in which Ripple was distributing its XRP token through primary transactions, not secondary transactions, is a very important distinction here. Because the judge effectively punted on the question of secondary transactions. And even within that context, she had a very interesting take on protection of institutions on the one hand and no investor protections for retail investors on the other, which is odd simply because securities laws were put in place specifically for the protection of individual investors. So with all of that said, it looks very much like the SEC is going to appeal this ruling to the Second Circuit Court of Appeals. It may ultimately end up with the Supreme Court, which is our expectation. So this is round one, and it's inconclusive.
How does this further impact some of the offerings that Coin has wanted to put out too, of its either own currency or for the number of currencies that are listed through Coinbase at this point?
Well, again, XRP was not one of the tokens that was identified by the SEC as an illegally traded security, i.e. a crypto token that was a security on Coinbase's platform. With all of those others, it remains a question. And yes, what the market is doing right now is reading through from the Ripple ruling to all of those other securities and suggesting that, that they are now scot-free. We think that if you look at the Howey test specifically, one of the points there is that there's an expectation of profit arising from the efforts of others. According to the judge, in retail transactions, those others are the buyers on the other end of a transaction. They're anonymous. You don't know who they are. That's an odd interpretation of the Howey test as we see it. In most judges' thinking that we've heard so far, the expectation of profit based on the efforts of others in this case would be based on Ripple Labs and its promotion of the Ripple ecosystem. In the same way that if you buy IBM shares, you're doing so in the expectation of profit based on what IBM does as a company and its operating performance. The fact that this is looking at that transaction very differently, I think is something that needs to be considered.
Yeah, I want to zoom out for just a second here, and Kavita, give you the last word on this, because we have this case. We had yesterday Alex Mashinsky of Celsius, the founder of Celsius, being arrested and charged by the SEC. Where are we in this sort of crypto cycle here? You know, the fact that we're still arguing over these sort of definitional, foundational regulations at the same time that we are still seeing fraud in the system. What's the big picture?
It's a very good question, Julie. And I honestly believe that we are still at the very early stage. But being in crypto since 2013, I feel like at least the crypto has arrived the place where the mainstream media is really pushing to understand where does the regulation works. So we do have projects like 3AC and FTX and like the bad actors like any other industry. And the more regulations and the more clarity on where do we stand is really going to help and protect the retail customers, and also going to help and have the guideline of how founders and investors need to go into the place. Said that, I think at the same time, I also do believe what Mark said, that we are going to see the digital asset regulations in the Supreme Court. But the positive side, again, which I want to underline is decentralization a key, a way to distribute token is the key, the way of sales or the token itself, an instrument itself has to go through those regulations. Having a clarity of it will push the overall blockchain industry, which is still, I believe, in the early stage when we compare it to the tech industry, very similar to how privacy laws or encryption laws accessible to everybody is. My last thought would be here is clarity is great. Otherwise, US is already on the brink of losing some of the best tech from the blockchain community. And I don't think that's going to be helpful for anyone.
Mark Kavita, thank you so much for your time here this morning. Berenberg Capital Markets Senior Equity Research Analyst Mark Palmer and Delta Blockchain Fund General Partner Kavita Gupta. Thank you. Well, Hollywood actors have joined writers on the picket line. SAG-AFTRA, the union that represents over 160,000 professionals in the industry, has voted to go on strike after failing to get to a deal with a major studio. This is the first time that writers and actors are striking at the same time since 1960. Joining us now, Yahoo Finance reporter Alexander Canal. Ali, set the scene for this. So what does it mean that they're both striking?
Well, it likely means that we won't see an immediate impact, given the fact that the content pipeline is very baked in at this point. However, it's likely that we will see the delay of shows, series, episodes beginning in 2024. And if you think about where we're at in the media environment right now, it's very disruptive. That's what Bob Iger was talking about during that CNBC interview yesterday, saying the union demands were not realistic given this fragmented environment where cord cutting is escalating, direct-to-consumer remains unprofitable. He said it was, quote, very disturbing that these strikes would be happening concurrently at this critical time for the industry. But SAG-AFTRA fighting back on those comments, saying they are the ones that are being taken advantage of given where contracts are today and how they don't account for streaming residuals, AI, and all of these advancements in media. Fran Drescher, she's president of SAG-AFTRA. She's also an actress herself. She spoke following the announcement of these strikes. Take a listen to what she had to say.
We are the victims here. We are being victimized by a very greedy entity. I am shocked by the way the people that we have been in business with are treating us. I cannot believe it, quite frankly. How far apart we are on so many things. How they plead poverty, that they're losing money left and right when giving hundreds of millions of dollars to their CEOs.
So some really fiery words there. You can really feel the passion on all sides here because the stakes are high for everyone. And not to mention those Hollywood adjacent businesses, those businesses that rely on production, think craft services, transportation companies, studio crews. I mean, there's a ripple effect here beyond just those media companies. The writers are currently in month 3 of their own strike with no end in sight. Now with SAG joining them, the damage here could be quite devastating, especially the longer this goes on.
All right, Ali, stay with us. We've got another discussion that's coming your way. The fight in Hollywood heating up as actors and writers come together on the picket line for the first time in over 60 years. So how will this impact studios and streamers? Joining us now, we've got Michael Pachter, Wedbush Managing Director of Equity Research, and we still have our very own Ali Canal here. Michael, thanks for joining us this morning for the conversation. So from your perspective, does this change the calculus about how you evaluate these companies that are still in the business of creating content to try and drive even more subscriptions?
Yeah, it makes me question the judgment of their managements. And I actually agree with Fran Drescher. I think the studios are just completely wrong on this one. I'm not suggesting that they cave, but I'm suggesting that they compromise, and they just haven't even begun discussions with the writers. The actors obviously just went out on strike. So yeah, content's their lifeblood. They're being really foolish about this. And, Ali pointed out that the biggest impact is on scheduled series, commercial broadcast, and in particular daily television, so soap operas and late night. Those guys are going to have to stop production like now. So that's a real problem. And then it's going to become a huge problem in September when the new season for broadcast television starts. The streamers aren't hit as bad. And in fairness, Netflix is like profitable. They're the only profitable streamer. So they can afford to kind of hang out and do nothing. They can shift production overseas. They're making 25 Korean language television shows as we speak. And they can pay up for catalog, some more Seinfeld. And their viewers aren't going to really notice because there's something like 15,000 different titles on Netflix. So you'll always find something to watch there. But broadcast is in big, big trouble, and I really question the judgment of the managements.
So, Michael, given that point, do you think Netflix is best positioned to weather both of these strikes when you look at all of the media and cable and entertainment companies right now?
Yeah, by far. The movie studio, first, it's the commercial broadcast guys that are hit. Second, it's the movie studios, because you're right that it's not going to hit anybody till 2024. But if you have no summer films for 2024, if you let this thing drag out 2 or 3 more months, they're screwed, and theaters are screwed. So the movie studios have to get to the table. Fortunately for them, Netflix sucks at making movies. I mean, they haven't made a good one yet. And, the handful that they've made that a lot of people have watched kind of keep you busy for another 2 hours, but they don't really care. And they've been pissing money away on film because they don't have theatrical. So they lose the biggest revenue piece of the pie. They don't have DVD sales. So they're really de-emphasizing studio films anyway. And they're focused more on television. And what they've really discovered is foreign language TV plays well in the US and elsewhere. So Spanish language plays kind of globally. You're seeing a slew of Scandinavian shows showing up in the US that are dubbed. I saw a Turkish show the other day, and I didn't even know Turkey made spy thrillers, but it looked very much like a US show. So Korean TV works. They're going to be absolutely fine. And they're the problem. They're the problem. The studios fed them and made them successful, and now the studios are suffering because they're trying to compete and they can't afford to compete. Netflix would love this to drag on for 5 more years. So they're the wrong guys to look at to be the first to cave. They will not be the first.
Michael, I was really struck yesterday by Bob Iger's comment in an interview that it's not realistic what the actors and writers are asking for. Which I found sort of unusually adversarial. And I just wonder, I've seen a lot of sort of vilifying, too, of he and some of the other CEOs who are taking home very hefty paychecks, right? The relationship between the studios and the actors and writers, is there a chance of permanent damage there? And does it even matter? I mean, do they even have a choice but to work with each other?
Yes, permanent damage, and no, it doesn't matter. I mean, it's a great headline. Iger made $65 million. That's like 25% of the cost of Guardians of the Galaxy. So who cares? I mean, it's a lot of money for an individual, but that $65 million wouldn't be spread very far among the Actors Guild or the Writers Guild. So what matters more is Iger's attitude, and Iger's as big a part of the problem as anybody, because he decided to chase streaming, and before he chased it, he supported it. So he used to license Disney content. They pulled their movies off of Stars, and gave them to Netflix. He's one of the biggest reasons Netflix has succeeded. I think the biggest culprit was probably Les Moonves, who's not employed anymore. But these guys were so quick to reward shareholders by licensing content immediately to Netflix as soon as the season ended, that they propped up Netflix and they made Netflix into this big threat. Then they all stupidly decided to follow Netflix. What they should have done is pulled their content from Netflix and kept it off of streaming for 3 years and not allowed us to become accustomed to an inexpensive way to view a mass quantity of high quality content. They blew it. And he's the biggest, second biggest behind MoveVest, biggest culprit. So for him to say it's not realistic, look at sports. Sports has figured this out. They pay out 50% of overall revenue to the athletes. And somehow that works. And what happened? Yeah, the price of a ticket to a football game went from $25 to $200 or more. But we got more television. We have now, Monday night, Thursday night, Sunday night football. We used to only have one. So more football on TV because they have to pay the athletes more. You'll get better distribution of film to televised content if they pay the actors more, and you'll get better content. I think Iger, who's only a few years older than me, is a Luddite. It doesn't get the tech, is afraid of it, is emulating it poorly, and I think he's just completely wrong.
Now, if we could just do something about my forced exposure to watching the Giants or New York sports versus watching my Philadelphia Eagles in this territory and market. Anyway, that's for another conversation. Michael, stay with us. Allie, thanks for joining us this morning. We've got one more topic to touch on here. As you were mentioning Netflix, of course, Netflix does kick off earnings for the streamers on Wednesday. The company's revenue is expected to grow over 3% year over year in its second quarter. All eyes are going to be on the impact of the streaming giant's password crackdown and ad tier. We're bringing back in Michael Pachter, Wedbush Managing Director of Equity Research here. Michael, just run us through some of your expectations. Did they impress this quarter from your estimation?
I expect the Phillies to compete pretty favorably for a World Series title, so you won't be completely disappointed. Netflix guidance was pretty wimpy, 2 million subscribers and kind of a modest revenue guide. And it incorporated a couple of changes they made. They introduced an ad-supported tier more than a quarter ago, and they started cracking down on password sharing. And none of us really know what the metrics are for either one of those things. We're seeing good third-party data, primarily from Canada, where they've kind of accelerated this stuff, showing that the ad-supported tier is working and that fewer people are quitting. And when they do sign up, they're signing up for more expensive plans. The password sharing is really interesting because, they're giving us an opportunity to buy a second and third subscription instead of just terminating whoever's sharing our password. And they're doing it at a discount. So it's actually pretty cheap. I have 2 daughters who just graduated from college, both moved back home. But when they move out, I'm going to buy them each a $7.99 subscription. And I'm not sure how that plays on the published metrics. Is it 2 more subscribers or higher ARPU for my household? I suspect the latter. But I think you're going to get a good report next week. I think you're going to see ARPU tick up. And I'm not talking $5. I'm talking 10 or 20 cents. But it'll be a trend. And I think if they don't miss on subscribers, they won't. And if ARPU goes up, it will. That stock's going to scream higher, because what they've done is successfully transformed themselves from a zero profit, money losing, fast growth company that people paid for growth into a slow growth, extremely profitable company. They are the guys that Disney Plus would like to be. Disney Plus just hasn't figured out how to do it yet.
Michael, all of that said, this is a stock that's up 51% year to date and is trading at something like 39 times forward earnings. So, does it not only have to beat, it has to really beat, right? When it comes to these numbers?
If you think that the average subscriber in the West is paying $180 a year and the average subscriber globally is paying over 100, it's not that hard for them to add 10 million subs and add $1 billion in revenue. Their incremental cost is the technology cost to deliver the stream. That's it. So maybe 20% of that. So I think you could see these guys grow earnings by $2 to $3 a year, kind of in perpetuity. So if you go from 12 to 15 to 18 to 21, it's really not an expensive stock at all. Remember, I had to sell on this thing, from 3 to 690, and then it started to go down, and I got lucky with my upgrade to buy at 193. So yeah, I know exactly how much it's moved. But realistically, I think if they do what they're supposed to do, which is make money, it's going back to 600, 690.
All right, we'll see. We'll see if how much money exactly they're going to be making. Michael Pachter, good to get your perspective. Ed Bush, Managing Director of Equity Research. Appreciate it.
Well, taking a look at one of the biggest tickers of the year now, NVIDIA stock rallying even further into record ground after Truist boosts the price target by 16%. Shares moving higher right now by about 3%.
Yeah, not just moving higher, but they are at a record. And, when we have this discussion about going into earnings, what are the expectations? NVIDIA is like the poster child for this, right? Because of its big surprise and its big forecast boost the last time around, now, because of its sort of emblematic status as being what all of the AI hopes are baked into, this stock has skyrocketed this year, and it just keeps going up. It reports its earnings a little bit later than the rest of big tech here. Its earnings date is not until later in August.
Right.
But just the fact that it is rising once again, trading at a record, it's up more than 200% year to date, and now this Truist analyst boosting the price target to $545. It's just kind of incredible.
Well, NVIDIA cemented chips as the defining indicator as to where generative AI demand would actually come into play and who could monetize it first. And NVIDIA with DGX Cloud and some of the other players, AMD added on to some of that fervor around it. We heard from Micron. So all of these chip players trying to figure out how they can carve their own space in the narrative, in the hype phase as well, that's driven NVIDIA to these record highs. We've continued to track since their earnings took place, and even more of the updates that they've given over that time.
Indeed.
Yeah.
All right, we're taking a break. You're watching Yahoo Finance. What do you predict will be the theme of this earnings season?
Resilience, I think. I think it will be. We have a resilient economy, and I expect to see resilient earnings. So I think that will please the bulls overall.
Earnings season is off to quite a start, right? The big companies that we've heard from thus far, the likes of Delta, the likes of Pepsi, and then the big banks like JPMorgan, Wells Fargo, and Citi, all of them come out and beat estimates. The question going into this earnings season is beating the numbers enough, right? We've had a lot of discussion about whether it is a low bar going into this season or a high bar for these companies, given that stocks have already rallied quite a bit going into this earnings season. I'm Julie Hyman. This, of course, is Brad Smith sitting next to me, along with Miles Udland and Brian Sazi, all of Yahoo Finance. We're going to talk a little bit about this earnings season and whether indeed the expectations are high or low coming into it. Brad, we've been putting this question a lot to investors over the past couple of weeks.
We have been, and now we have to answer it, at least based on some data here. FactSet said that the highest number of S&P 500 issuing positive EPS guidances since Q3 2021 is happening right now in advance of this earnings season, that data dropping from FactSet. It kind of tees up some of the expectations. We were speaking with Delta CEO Ed Bastian about what he's expecting this earnings season. Choppiness is the language that he used, especially given some of the demand that the travel industry continues to see persist, whereas in some of the goods producing services out there, you could still see areas like appliances, like home goods and home furnishings, rather, apparel, footwear, electronics, that continue to sputter. And that's going to be interesting to see how the health of the consumer is talked about, as we've gotten some inclinations from bank CEOs to determine over the past couple hours this morning.
Yeah, I think what's interesting about this earnings season is that the headline number is expected to be bad again, even worse than it was last quarter in terms of year-over-year earnings declines for the S&P 500. But if you start to decompose that, you see that it's pretty much all about what's happening in energy, whereas this time last year, very good time to be an oil and gas major. Gas prices are very high, record profits for the likes of Exxon and others. This year, those companies are going to have very bad results. So S&P overall earnings expected to be down 7% in the second quarter. But look at sectors like communication services, look at sectors like consumer discretionary, and there we see earnings expectations for increases, double-digit percentages over last year. That's what's happening in the stock market right now. And I think what we are learning again, and maybe investors don't forget this, but maybe pundits like us forget this, that all that matters for the stock market is what people think earnings are going to be 1, 2, 6 quarters down the road. And that outlook, Saz, has started to improve, has been improving for some time. It really inflected at the end of first quarter earnings season. And to me, kind of everything we've seen in the stock market continues to suggest that investors don't think it is time yet to stop revising higher future earnings expectations.
Yeah, right on, Miles. I think we have to redefine what an earnings beat is. Back in the day, maybe 5 or 10 years ago, you beat by 2 cents, your stock price goes up, and that's great. But I think this week we saw PepsiCo come out, blow investors away with its earnings results. We had a very upbeat tone from CFO at PepsiCo, Hugh Johnston, on our network. They came out, raised guidance for the second time this year. Big. You mentioned your conversation with Delta CEO Ed Bastian. Big earnings beat, big outlook from the company. And if you want to go back further, we can blame this resetting of expectations on NVIDIA. This company came out on May 24th and raised their sales outlook by $4 billion. I've been doing this for over 20 years. I've never, ever seen anything like that before in my life. And I think it raised the bar for a lot of companies, not only for companies like NVIDIA, but many other companies.
Well, and I think what's interesting about that, so it's $4 billion. It's a 50% increase in the range they were expecting for, I think, current quarter revenue, if I'm not mistaken. Yes. And so in the way that last year, if you look at it, for all the big tech type companies, it was like, well, all these expectations need to come down, whether that was for your headcount, for your investments. I mean, look at kind of what happened with the copycat nature of the rolling layoffs that we saw at the end of last year. Now I think investors are waiting for all these kinds of companies to maybe grow into the bar that NVIDIA has set. NVIDIA is saying there is an additional $4 billion worth of capital expenditures available for us, and then you kind of tam it out. You say, well, that means there's $30 billion enterprise software wide. So then you go around the market and you say, well, you should get this much, you should get that much. Why haven't you, company X, revised up your earnings yet? And I know it's a little tangential to the conversation. Your morning brief this morning, Saz, on Amazon did make me think of sort of like, where's AWS in this? Where's Andy Jassy coming out and saying, like, here's my $5 billion
Well,
beat?
the expectations for Amazon have certainly been raised, and it is not only for the second quarter, it's for the third quarter. You go to Yahoo Finance, type in NVIDIA, go to the analytical section. We have all the estimates on there, and you will see that analysts raised their estimates for sales for the third quarter by $1 billion. So NVIDIA not only reset expectations for the second quarter, they reset it for the third quarter, the fourth quarter, you name it. And unless Amazon is going to start selling generative AI chips, they might be in trouble.
But the AI elixir, as many have called it, it's not going to be the same this earnings period. In fact, the term that everybody was throwing out there in generative AI and how even a company like a Coca-Cola would use that. Who knew? Who knew that would get brought up in their earnings conversation as well last quarter? But this quarter, the term that's being thrown around even more so is resiliency. You're probably going to hear more about that. You've heard that from some of the bank earnings this morning, even how they describe the consumer right now. But what else might you hear? You might hear about normalization at the end of the day. You were describing how companies are going to have to prove the narrative that they put out there last quarter. Well, in an environment of normalization, then investors are going to say, okay, what does that mean in terms of your own growth? And are you able to actually grow into that valuation that we were able to give you before?
Well, that's a good point about normalization, because that's something that JPMorgan actually talked about on the call this morning, right? When you look at something like credit losses, there's a lot of consternation about how many people are not going to be paying back their debts in this environment. And JPMorgan said, yes, it's going up. Yes, it's an area of concern, but it's just going back to where it was pre-pandemic. It is a normalization period. Also on the normalization front, and also on the tech side, the UBS call this morning on Microsoft, where it talked about cloud infrastructure spending and called out both Azure and AWS and said, it's not that things are going great, but they're not getting worse. So there, it's a more of a stabilization. So it feels like we're getting at least some of the commentary coming out, whatever sector you're talking about, is that we're still finding that equilibrium.
And I think what's interesting about, I was talking to someone about this offline earlier this week, about exactly what you were saying, Brad, about the resilience frame. And this point that every company went back to over the last couple of quarters, you could always say, macroeconomic situation, macroeconomic concerns. I don't know, it was tough environment out there. And companies are rapidly coming up to their earnings calls. Those prepared comments, how you want to frame it, the numbers are certainly baked. The framing of it is probably baked. That's probably been with legal and compliance for some time. But I don't think as a management company, Saz, you can come out in 2 weeks or next week, if you are, regardless of what industry you're in, and say, tough economic environment. We missed our numbers because the macroeconomic environment continues to be tough because, Brad, that resilience for the economy kind of flipped. Now it's just growth again. And so I don't know if you have the legs to stand on to say,
hell no.
I'm sorry I screwed up. It was actually the other guy.
It was the other guy. What we have seen this week, this has been the week of the everything rally. And your news team, Miles, described it or covered it perfectly with the CPI release. That set off a whole, I think, tone change in the markets where everything is rallying across the board because have we entered a sweet spot for the markets where you have...
Dare I say Goldilocks?
Goldilocks, yes, you can. You have inflation slowing down. You have companies like PepsiCo and JPMorgan calling out strong demand environment. Wow, that darn seems like a very perfect setup for investors to have more gains going into the end of the year, which means the market might fall.
Now, just a word of caution here. It is still very early in this earnings season, right? This is just a little itty-bitty beginning of it. We still have big tech to get through. We still have a lot of the big industrials to get through. We still have a lot of the financials to get through, for that matter. Consumer products companies, all of it, we still have to get through it. So there still could be
Rivian's not going to make any money. Lucid not making any money, but still, NVIDIA's going to have a great quarter.
Rivian and Lucid are not moving the entire market, right? Like Apple and Amazon and Microsoft and Alphabet are going to be moving the entire market. One quick note on NVIDIA, too, as we think about the effect with which it landed last season. It is super late in earnings season. Just sort of thinking about the calendar. It's it's August 23rd is the due date for
They should report every week.
NVIDIA.
The story is so exciting. Just release your earnings.
No one should even be at work on August 23rd.
No,
they should be closing the stock market,
checking out NVIDIA,
having a Mai Tai or something.
But the flip in this too that you may see, and even as we get into some of those tech earnings, is where the business-to-business narrative is also continuing to move forward. If you come out and hear companies like Amazon, and especially in their AWS business, or Microsoft saying within their own cloud businesses that they are seeing some type of growth profile that they didn't even expect because some of the companies that they buy into, or companies that buy into them, are purchasing more, then that puts on a spending profile from a business perspective that says, all right, we're confident enough to redeploy capital.
And I think that gets to the conversation about how challenging it's going to be for management teams to figure out what the narrative is they want to put into market, because again, last year you could always just say IT spending is pulling back. Like, you had 100% cover to be like, who knows about that environment, but I'm not sure that that's really going to hold anymore. And again, if it stops getting worse, to kind of the point UBS was making this morning, that's all investors have really been reacting to. Apparently that's worth almost 20% on the S&P 500 in 7 months.
Well, and they've cut all the fat, right? That's the other thing with all these companies.
Yeah.
I mean, even though there's some reports more recently this week that Microsoft is cutting a few more people, but overall, like, it feels like the bulk of the cutting within tech specifically has been done. So then, if things aren't getting worse, like, it's nothing but gravy, right, from here, at least in theory.
Yeah, and I think then we get to, okay, so if it's no longer just resilience, but it's an inflection in the business cycle, then we get to kind of one of my favorite subtopics in markets, which is like, do you have the right CEO for the moment? What moment are you in, and do you have the CEO for growth? Do you need defensiveness? Is that your executive? Do you need a wartime CEO, which was kind of what the pandemic kind of brought to the fore? And I think a lot of companies right now saw is that looked at the world one way, said we got through the pandemic, we have the cost cutter in charge right now, we have the responsible leader, but does that person have the vision to get us through a new business cycle that is kind of starting anew here? Let's say it wasn't in a formal recession, but let's call 2022 a recession. So 2023, 4-year expansion ahead of us. Is this the right person to get us there?
Well, Disney did all of those, so they hit the Bob button once again.
Right. Yeah, where's the stock at? Did we talk about this yesterday? I feel like I was losing my mind. Everyone's like, Bob Iger, it's so great. Stock hasn't done anything.
Yeah.
But that's neither here nor there.
Bob Iger's pricing.
He doesn't need to hear it from me.
He's pricing Disney. But I'm glad you mentioned that because I'm going to give you another ticker for Josh Schaefer's look ahead column that hits on Sunday evening. That's Goldman Sachs earnings. When earnings come out, I think there's going to be a real more scrutiny on this report than the normal, especially with David Solomon. I think he's gotten a pass the past 2 quarters, but it is crunch time for that company. And there might be just a reawakening on what type of leader, to your point, a Goldman Sachs needs. They need a company someone that comes up there and just cuts expenses, gets really faster out of businesses, because David Solomon, he's got a lot of L's on his time here, and the clock might be ticking.
Yeah, I know we always talk about the issue of like, the board composition, are they too close to these CEOs? It's always good for that conversation when we talk about should leaders be changed at the top of some of these companies. All right, guys, it's going to be fun this earnings season. Looking forward to covering all of it with all of you. Keep it right here on Yahoo Finance.